Ladies and gentlemen, good day and welcome to the CSL Finance Limited Q4 FY23 earnings conference call hosted by TIL Advisors Private Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sayam Pokarna from TIL Advisors Private Limited. Thank you, and over to you, sir.
Thank you, Darwin. Hello, everyone. Good afternoon, and thanks for joining the Q4 and FY23 earnings conference call of CSL Finance Limited. The results and investor presentation have been updated on the stock exchange and on the company website. In case someone does not have a copy, please feel free to reach out to us or to be added to the mailing list. To take us through today's results and update us on the business, we have with us Mr. Rohit Gupta, Managing Director, Mr. Amit Ranjan, Chief Operating Officer, Mr. Naresh Chandra Vashne, Chief Financial Officer, Mr. Chandan Kumar, Credit Head, and Ms. Rachita Gupta, Full-Time Director. We will be starting with a brief overview of the quarter gone by and of the whole financial year from Rohit sir, followed by a Q&A session. I would like to remind you all that anything and everything that is said on this call that represents any outlook for the future, which can be construed as a forward-looking statement, must be viewed in conjunction with the risks and uncertainties that we face. These risks have been mentioned in our annual report. Over to you, Rohit sir.
Yeah, thank you, Sam. Good evening, everybody. I welcome you all to the Quarter 4 and the Financial Year 23 earnings call of CSL Finance Limited. Thank you all for taking out time to attend this call. It is a pleasure to address you all today and walk you through our performance for the quarter and the full financial year. So first of all, I will start with an update on our balance sheet. So our loan book stands at highest ever at 732 crore as of financial year 23, an increase of 41% year on year, and an increase of 8% quarter on quarter compared to quarter 3 financial year 23. More importantly, the mix of AUM stands at 60% portfolio and 40% SME retail portfolio, the highest ever in favor of SME retail. As many of you are already aware, we have been trying to grow our SME retail book faster, the results of which have been visible in our previous year's performance. The total disbursement for this quarter stood at 147 crore, which is lower both on year-on-year and quarter-on-quarter. The main reason for this has been intentionally lower disbursement on wholesale side. As we have explained earlier also, the wholesale is a little lumpy both in terms of disbursement and collection. Sometime in a particular quarter, we do a much higher disbursements and corresponding with the collections are also higher, so it's a little factor of collections also, and sometimes proposals culminate more in a particular quarter. That's why so it's better to see wholesale business from year-on-year perspective than on quarter-on-quarter. And whereas the disbursement on the SME retail front have been good in quarter 4, same as quarter 3. So collection efficiency as a whole for the company is 99%. A trend consistent for entire financial year, where our wholesale book has been with 0 DPD and it's around 98.5% on the SME side. So you will notice we are carrying some higher liquidity as on 31st March 23, which was primarily on account of some scheduled NCD repayments in April 2023, which we have paid amounting to 40 crores. We have enough sanctions. We have enough sanctions in hand from the newly onboarded lenders as well as from existing lenders for the coming quarters. On the leverage front, we have leveraged our book to 1.13x as of financial year 23 compared to 0.64 as of financial year 22 and 0.98 for the quarter 3 financial year 23. We are maintaining a healthy capital adequacy ratio of 50% and a comfortable headroom to growth on the leverage side, especially now that we have a higher mix of SME retail in our loan book. The latest 4 lenders to be added to our portfolio of 15 lenders are Muthoot, Capital Services, Utkarsh, Fincare, and STCI Finance. We also received new sanction from existing lending partners like HDFC Bank and Tata Capital. I would also like to bring to attention our continuously improving asset quality, where we have been seeing a consistent decrease in our GNPA and net NPA for the last 8 quarters. As of financial year 23, GNPA stands at 0.61% and NPA stands at 0.35%. These have been more than provided for. Our provision coverage ratio stands more than 200%. In this year, we have also recovered bad debts amounting to rupees 2.33 crores in financial year 23. We continue to show good traction on the recovery side in the coming year also. So now coming to the profit and loss side. Our total income stands at 118 crores, an increase of 57% over financial year 22, primarily on account of growing loan book. Our net interest income stood at 88 crores, an increase of 43% over financial year. As you may have noticed that net interest income growth has been lesser in financial 23 because of increased borrowing costs linked to MCLR and repo rates. These higher borrowing costs have especially kicked off during quarter 3 and quarter 4, and that is why the NIM have little dropped in those quarters. Going forward in coming few quarters, these costs will be passed on our customers, which will help us to improve our net interest margin. Further, as a strategic move, we are getting more active on transitioning our wholesale book towards floating rates, which will insulate us from sudden moves in interest rates going forward. You will see effects of this in coming 3 quarters. Subsequently, our PAT for the year stood at 146 crores, as an increase of 36% over the previous year. We maintain an ROE of 12.56% and ROA of 6.94% for this financial year. Now coming to the operational update part. Operationally, we have been pushing out a lot of improvements on our tech side. The customer onboarding loan underwriting platform has witnessed a lot of improvements over the last year, and many have been laid out in the roadmap given in our investor presentation for the coming year. Compared to a year ago, we are now much more confident of our technology capabilities, processes, team on the SME retail front. A lot of focus is on improving employee and branch level efficiency with the extensive training and migration programs already undertaken in financial year 23 and also planned for financial year 24. We are focusing on metrics like AUM per branch, AUM per employee, and all efforts are going towards improving these metrics, so we see a better cost to income ratio. Looking at going forward, looking at response on our SME retail side, and with more confidence in our abilities in this division, we'll be moving forward with the rolling out 6 to 10 new branches in the coming financial year. We may also take shutdown of some underperforming 1 or 2 branches, so the net branch addition will be of the tune of 8 to 10 branches in this financial year. On the team side, employee addition will happen on the branch level with new branches, but at HO level, we are well placed to cater to a larger set of operations. We will go for credit rating review in the current financial year. Coming to our AUM mix, we further see a transition from our current 60-40 mix to 50-50 mix by the end of the next financial year. We are optimistic about the outlook for financial year 24 as the company possesses the required team, technology, processes and capital for the coming year. Now, this was a brief update on all parameters. Now, I put our team and myself to questions from your side.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vishal Prasad from VP Capital. Please go ahead.
Hi, good evening. Sir, SME loans we have started a few years back and we have been ramping it up very, very aggressively. So now it is 40-60. We plan to make it 50-50 next year probably. So if you could talk about where do we see SME versus wholesale in next 3-4 years, and since we are slightly new in SME segment. So what kind of risk do we see that we may face going forward, and how we are trying to mitigate it?
So the next year we have planned ourselves that we try to achieve a 50-50 mix, and we are very hopeful that we'll be able to do it based on the team addition and the kind of effort which has gone during last financial year, both in terms of processes, technology, training, and the business which we have done. And now the team is fully motivated, head up for the targets which we have set for those zones and branches. As a broader level, we see that, focus will be more on the SME side, but depending upon the dynamics of the market, and we see that 50-50 to 60-40 may be a optimum level in next 2 to 3 years. But certain things are little dynamic, and if we see more space and become more confident as going forward, the SME will be our the focus area. And thirdly, I think Amit will also add on the risk side. As a company, we have always thought of gradual expansion on the SME side, just because we want to see that what kind of risks are coming, and those risks we are taken care of through our processes and enhancements in the credit policy and parameters which we keep, and through the digital platform which we have kept, which start giving us information and start doing data analysis. So the core purpose of shifting to this platform, where a lot of effort has been done by the company in last financial year, last 18 months, and going forward, still it's an ongoing process, and in next 6 months, we hope to see that the first level of, to larger extent, the platform will be fully ready. And so I think Amit will add more on the risk side as your talk.
Yeah, hi Vishal. Basically in SME, the main question you asked was what are the challenges we are going to face in coming financial year. First of all, the challenges were earlier also, and challenges will be there in future and present. So we need to be very, very careful in identifying our clients, and we are not going very aggressively in terms of doing business. We want to have a very organic growth, and a cluster-wise approach is required. Wherever we are present, we are expanding within those areas only. We are not getting into new geographies, because that is going to be a new area after 1.5 years. And in terms of underwriting, we are trying to make most of the thing from subjectivity to objectivity by putting certain 10 to 11 parameters on which these clients are analyzed for their eligibility. So most of the things will be based on the platform derived, and a lot of algorithm is going to be made in coming 6 months based on specific industries. Whatever we have done in past 18 months, we have enough data on which our analytical team is working on, and we are trying to get most of the inferences from the past business, and we try to rebuild on that information from this financial year. And like I said earlier, we are not aggressive. We don't want to open most of the branches, and then there'll be issue in justifying the cost also. So we will be very cautious in opening branches. We will be very cautious in again identifying the right kind of client. Mostly since it is direct marketing team which we are doing, and direct sourcing from the market. So the most of the client will be new to the company, and they will be new to credit. So it will be easier for us to make them understand, educate also, that paying EMIs on time is good for them, so that they can come under main banking mainstream. So that's the idea we carry for SME for this coming financial year, and we intend to do at least a new book of 200 or 210 to 20 crores in this financial year.
Sure, thank you. So what's the current break-even AUM for a branch?
So currently in branch, if we open up, it takes around 6.5 to 7 crores to have a break-even, and then start making a profitability. So at least 7 crores of a business is required for a branch, which comprises of a branch manager, credit manager, and 3 to 4 RM and RO. So this, and it also depends on the rentals, because we are present in tier 2, tier 3 cities. The rentals and the cost of manpower also differs. So ideally, on an average, it requires 7 crores of an AUM, by which only we can go for a break-even.
Okay, so based on this 7 crore and what figures I got in the previous call, so you have mentioned that the branch becomes break-even at 7 crore, become decently profitable at 10 crore, and at 20 crore the branch is doing reasonably good. So out of 26 branches, how many of our branches are doing more than 20 crore and between 10 to 20?
So in our 26 branches, few branches we have shifted from one location to different location, and there are addition of around 4 to 5 branches. But since we have started doing business from July 21 onwards, prior to that it was COVID, the business has not happened and it was in a lull period. So from July 21 till now, there are at least 50% of the branches which has crossed 10 crores. In 20 crores range, there is not any branches. Why? Because the ticket size we are maintaining at an average of around 10 to 12 lakhs. So reaching 20 crores this financial year, I hope that at least 50% of my branches will cross 20 crores of an AUM.
Okay, so generally our AUM per branch is 7.92 crores, and we are breaking at 7. So, and I understand most of our branches are new, probably they are barely profitable. So if we today decide that we are not going to open any more branches and we operate with these 26 that we have, so over a period of 2-3 years, when the new branches become more established, what kind of change do we see in terms of profitability of the SME segment?
So in terms of profitability, like I said earlier also, we are not aggressive in opening branches, but we will definitely add on few branches in this financial year. So in terms of profitability, we see at least 2.5x in terms of per branch, because 7.5 to 8 crores we have already achieved at least in 80 to 85% of the branches. So moving from here will be all, because we are not adding any manpower, additional manpower in any of the branches. It will be only a replacement cost which will be there. So we intend to do at least 2.5x profitability in coming 2 to 3 years.
So for a new branch, how much is the capex and opex that we're doing in the first year?
So capex is generally is not beyond for a year it is if we take salaries and fixed salaries and assets and rental part, it does not go beyond 15 to 20 lakhs. So we take at 3.5 lakhs to 4 lakhs a month. So at least 40-45 lakhs a year is the capex, opex, and the capex is not beyond 4 to 5 lakhs.
Okay. And out of 8 SME branches which are more than 3 years old, so what is the total AUM under these 8 branches?
That figure I will have to update you, but generally it is around 80 to 90 crores of that total branch, which is more than 3 years. 80 to 90 crores of the AUM we are maintaining, because practically if you see, most of the businesses happened in the past year and July 21 onwards only, when we were rebuilding the SME after the COVID period, and we have increased little bit on the penetration in the urban areas of the cities. So the ticket size also increased from 4 to 5 lakhs. Average ticket size also increased from 4 and 5 lakhs to 12 lakhs, 13 lakhs. So currently most of the branches which is more than 3 years will managing at least 80 to 90 crores of the AUM.
And pre-COVID portfolio is less than 30 crores as of now. We have seen lot of foreclosures in last financial year. So that was also one reason that where our portfolio has run down, and so now most of the portfolio is post-COVID. So it is less than 30 crores, around 15% of our portfolio, 12-13% of portfolio is pre-COVID portfolio.
Okay, thank you, sir.
Thank you. The next question is from the line of Ajay Sharma from Sycus Investments. Please go ahead.
Hi, thanks for taking my call. I just had a question.
Mr. Sharma, your line for you has been unmuted. So please go ahead.
Yeah. Hello.
Hello. Yes.
Yeah.
Am I audible? Yeah. So I had a few questions. The first is, what's the company's cost of funds?
The cost of funds, which was less than 10% at the start of the financial year, it is around 11.25 as of now, 11.2.
Okay. And do you see this going up or coming down over the next year?
11.1, and it has basically risen in last 1 or 2 quarters, and quarter 3 and quarter 4. So 11.1 is the weighted average cost of borrowing.
Okay. And do you see this going up or down in the next 1 year?
Now that pressure we have not seen in last 1.5 months, which was there, I would say, till March. Now, whatever we are speaking to a lot of new lenders for the next for this quarter, and we are not seeing that. Now we are seeing a little ease. Now we have a little more bargaining power in saying that to reduce the cost of borrowing as what was in March.
Okay. And I read on the presentation that the company is looking at launching an unsecured product. Can you tell us a little bit about this and also how you plan to manage risk with this product? Is it for existing customers or is it for new customers?
No, we plan to do that in the last quarter, but because of the platform, we built a different platform for that, and where we want to do it on the same day. So we are targeting a particular segment. It's a particular segment where we are having a data from a very big company which is providing that source to us, and with a little bit of, I would say, deterrence built for the borrowers. So that is a helping point for us, and so the ticket size will be around 2 to 3 lakhs to start with, and so we can better talk when we do a few accounts on that, and probably at the end of this quarter, few of the accounts will be onboarded, and after that, but rest, because most of those segments we are targeting, it's a niche segment where order-based raw material requirement for those people is required, and where I would say repayment fee will also happen within 60 to 90 days. So they are short-term, short tenure loans, and which will be consistent. If one pays, he will take again because they have a continuous flow of orders. So we don't see too much risk, and there will be certain, we have built certain credit parameters to do those loans. As of now, I can't say too much, but they are far better as compared to giving PL loans of 50,000, 1 lakh to public at large, than targeting a particular segment based on that where they have been doing business for last 3 to 5 years at least, and have a reasonable turnover. Sometimes the biggest risk from this segment comes when you don't have a credible data, but that will be a little advantage to us, as we'll be having a credible data in terms of whatever they have been doing business, in terms of business.
Okay. And along the same line, can you just talk a little bit about the client profile of your SME retail borrowers? Like, are they already in debt? What is their interest coverage? Is it the first time that they have access to formal lines of credit? Can you just give us a bit of information about them?
Yeah. Because first we have to understand the target audience of our SME division, because SME is a very wide word. From 5 lakhs to 5 crores people categorized as SME. Our target audience is tier 2, tier 3 cities, very small entrepreneurs like Karyana merchants, like small workshops, maybe cattle field, having multiple small sources of income within their family, running chemist shops, garment shops. So these small trading people in different segments, they are our primary customers in tier 2, tier 3 cities. And so to assess their interest coverage ratio, you will not get any audited or credible financial information in a collated format from them. And they do, most of them or some of them are not new to us. They are already having some personal loans or maybe a housing loans. So CIBIL and their credit history is one important parameter for us. Apart from that, what kind of turnovers and incomes they are generating based on their businesses. Vintage is very, very important because these families are mostly families where at least 4 to 6 people are living, sometimes joint brother with that. We take them as co-applicants and merge their collective income into that. And secondly, this is where a huge under-penetration is there, where 50 to 60% of India still lies, and where it has become very difficult for banks to penetrate these segments and to do collections from these segments. As a company, we focus that we have to build a knowledge around particular few segments, and if we are able to do that, so then our presence and a little edge we will have as compared to targeting a very matured SME manufacturer. Either they will be relying on bill discounting mode, maybe CC mode from banks. So that is not the segment where we can build a niche or competitiveness, our competitiveness will come. So, and this segment is neither can be fully breached through the fintech mode also, primarily being totally secured. Our 92% customers will take their self-occupied residential property, and we are doing a complete 13-year chain, not an imperfect kind of a mortgage. So these are fully collateralized, and LTVs are less than 50%, and where it's in a little lower habitation, we are taking not going more than 35%. So first, they are fully collateralized. First, secondly, they still are not fully penetrated. Thirdly, they can't be penetrated by larger banks the way they need to be assessed and they need to be serviced, and and that is why more and more banks are looking for co-lending with the NBFCs which are focusing in these areas, and most of them are falling under MSME Udyam registration. So these are priority sector loans. This comes into that. So, your question that you can make a reasonable assessment on the interest coverage ratio and all those ratios based on some audited or unaudited financial parameters, that is not there, as Amit has told. The various algos and how to make this objective an objective one based on their what kind of network they have, what kind of assets they have created, what kind of stock they are keeping, what kind of margins they may be enjoying, what kind of living standard they have, what kind of children, in which kind of schools they are studying. So based on how they have grown in last 10 years, when you collate all those parameters and put into a proper and run the algos and build a knowledge around that, I think reasonably you can do it. Definitely, there can be a 2 to 3% of NPA. Those are not NPAs because we are able to, from our track record of recovery in last 18 months, prior to that there was an embargo of classifying as an NPA. We are, because they are fully collateralized, we are able to recover, and the recovery from surface is far faster, which is 20 lakh plus, and in others, even multiple ways of execution, arbitration, and 138(1) also works good. So sometimes few cases get added up, some few cases we are getting a resolution. So having a large NPAs which can't be recovered seems not that probability is little lesser.
Okay. I understand. Now, see, I've been an investor with the company almost since 2015, and I've been very impressed with how the wholesale lending book has grown and how it's withstood COVID. So my question is, why go through the effort and the difficulty of building an SME retail book and building a sales force when you can focus more on the wholesale book and put the same effort there, and you'll expand much more, right?
No, you are absolutely right, but I think sometimes having a combination of both, retail where we want to build a knowledge, the same way we have built in the wholesale. So wholesale, there are 2-3 limitations. Because of ticket size, there's a lot of riders from the banks and the rating agencies that exposure per customer first is too much. Sometimes because of the lumpiness, in certain time, a lot of accounts get taken over, and thirdly, it gives us the SME is a very regular, granular business where disbursements are very happening regularly at a given rate per month, and collections are very predictable. With wholesale, where all those they do make the repayment before the repayment schedule. So we wanted that it gives a very good mix of both, and we are able to utilize our capital to the max, and may help us to bring more lenders into our profile, and help us to bring the visibility of our company as a whole also. So we think it was required, and that was why we have added it. Otherwise, as a company, why would have we added if we are able to think that the single wholesale business was fine? So that was our thought behind that.
Okay. And my final question is, do you have any forward guidance about the loan book?
Yeah, I'm not able to understand.
Do you have any forward guidance about the loan book? Any targets?
No, we have till date avoided giving no guidance, and but we have given a guidance on the product mix. Definitely now we are on a growth path from 4 lenders, which we were there for 3-4 years during COVID and post ILFS. Now we have focused a lot of building our liability side. Now we have 15 lenders, and we hope that much more lenders will come this year, and the focus is on growth. Both the divisions are now stabilized, team has been stabilized, the operating the platform and the policies. So the focus will definitely be on the growth side, and last 2 years have been reasonably good for the company. So putting numbers, definitely we have a lot of scope to leverage ourselves. We are only 1.13 through the debt route and at opportune time and by any other instrument. So yes, when we have made all those efforts in last 18 months, the focus will be on the growth, and definitely be achieving good numbers will be our focus.
Okay. Thanks, and all the best. Thank you very much.
Thank you. The next question is from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, Rohit and team. So my first question is, so I think if I look at the disbursement and loan book numbers, I think last year we disbursed around 760 crores, and our loan book has grown by 216 crores. So can you give some flavor as to, what are the typical, repayments in the loan book that we are having? And going forward, as the SME proportion increases, is that going to change? And a question tied to that is that, in terms of tenure for SME loans, are we looking at longer tenure SME loans? And if so, what is the current proportion, and how do we see that going forward?
There are 2 questions, one on the wholesale and one on the retail. I think Chandan will tell us about the wholesale on the tenures and the repayments and all this, and then I think Amit will take the second part.
Hi, Chandan this side. For wholesale loans, generally the general tenure is ranges between 36 to 48 months, in which is proposed from our side as a sanction terms. But being, as the Rohit has told you earlier, that the cash flows are very lumpy. So the cash flow from the project starts coming within the first year itself once the project gets launched. So as per our experience in the last 5 years, we see that for a general tenure of 48 months loan, it gets closed within 24 to 36 months within that period itself.
For group housing.
For group housing, for larger ticket size loans, I'm telling you. And for small builder loans, that is wholesale small. The average tenure is around 36 months, 24 to 36 months, where we can see a cash flow starts coming after 12 months when the part of the floor or part of the project gets sold, and within 24 months most of the account gets closed. So here you can see the collection in wholesale is very much lumpy, and we used to collect much more in advance than the scheduled repayment time. That is why the disbursement numbers and the loan book increase is on a mismatch side. Apart from that, you can see that there are in wholesale we do various kind of opportunity-based business where the loan gets itself closed within a particular year itself. So that comes into the disbursement and as well as the collection part also. But it does not impact our loan book. That is going incremental value to the loan book. That's a very kind of opportunity-based business where we enter into a particular financial year and get our exit into a particular financial year itself.
But we are focused on one segment only. We are not going into too many areas because as a company we strongly believe that we should only focus where we have built knowledge. What Chandan said, I just like to add, there are certain accounts which we board at a much higher IRR, but as those cash flows become much more stronger and certain times those get taken over at much lower rates by larger banks. So that is we at the time of boarding also understand this account will be for 6 to 9 months to 12 months, but Chandan has categorized these accounts as opportunity based, but they are from the real estate segment only. But at time of boarding we sometimes able to perceive that the customer will not be there with us for a very long period, and sometimes when he gets at a very attractive rate, it becomes very, very difficult to retain him. But those customers have been very, very repetitive with us because the kind of understanding they feel that we have about this segment and what is going around within the authorities and practically what is happening on the ground and what kind of decisions required to be taken at opportune time and with the speed. So they do come back to us.
And
on the retail side, yeah.
On the retail side, we have various products ranging from 4 years to 7 years maximum, and we don't intend to increase the tenor in coming financial year also. So average, it is almost like in the wholesale also, the onboarding of the client happens here in SME, and we also see that the balance transfer happening within 24 to 36 months. And average tenor currently in our complete portfolio is around 56 to 60 months. So we don't have any issues in maintaining the same tenor in the coming financial year also. There are cases which is around 5 to 4% where we think of giving little bit higher tenor like 8 years on, but there are only exceptional days. Primarily 95 to 97% of my book is less than 60 months on an average.
Even in those cases that they run down after 2-3 years, are either demanding a top up or they get taken over by other institutions.
So is it a fair understanding that as the SME proportion increases, then the disbursement to loan book ratio will improve further, because SME will have higher tenure?
I'm not able to.
Yeah, definitely. What Swapnil is asking that अभी जो loan book to disbursement ratio है, जो हमारा disbursement high रहता है loan book के लिए, so that will increase or not? मतलब हम बोला
increase on the SME, but wholesale. Lastly, because it is very granular. Last year we did around 145-50 crores on the retail and MSL side around 85 crores, and that is our SME. But definitely when the mix will improve, our disbursement on the wholesale will come down a little bit. Definitely.
And second question is on disbursement. So if you're looking at this number, even if considering that Q4 was an anomaly because we wanted to conserve liquidity, it's still in that 190-200 crore kind of a range. So and we have intention of scaling up SME per branch AUM. So next year, do we see more than 200 crore quarterly run rate going forward? How do you look at that number?
Quarterly run rate of the total disbursement?
Yeah.
Hopefully, sure. Definitely it should come.
The combination of SME and wholesale. Yes.
Wholesale, yeah. SME is more granular and wholesale is more bigger and some lumpy. So on year, I think we should be able to do that.
Okay. And last question. So from what was earlier discussed, at 7 crore number, generally our branches become break even on an average. So currently we are at 7.92, and So essentially, is it safe to say that at a portfolio level, SME is almost close to break even or slightly better than break even? And as we scale up, the incremental profitability will flow to the bottom line. That is the right way to look at it?
Yeah. We are profitable even right now. We only put, we just, I don't know how industry do that. When we assess our profitability internally, even our own equity, we put a cost to that. So then we say now the profitability has to come from that. Our weighted cost of borrowing is the cost of borrowing for our equity part also. So if we don't put that cost to that for our internal profitability metric, then even our rail is also profitable.
So what I'm hinting at is that the next year or the year after that,
definitely. As Amit has already explained, our OPEX will not increase too much in proportion to business which will be doing it. So definitely now the additional business will give us more margins as compared to as we have told last quarter also. Now most of the manpower to grow at 1,000 crore, we don't see too much addition except from the opening of the new branches or adding few more people to the existing branches.
And moreover, the platform is already ready. We have worked very hard for the last 18 months, and now it's time to scale up from those branches only. So, like I said earlier, also that we don't have to put more, cost into building a branch or hiring a manpower or building on a technology front. Also, we only have to go more into the market. Making the branches average productivity move from 20 lakhs to 1.25 crores. Similarly, then only we'll have profitability at all branches in much better way in coming financial year. Because with the platform which is set right now, it's only what we have to do is to pump in business from the same set of branches, adding few. And I don't see any reason why we cannot be profitable in all branches in coming financial year.
Okay. And last question on provision side. So I think we are doing far more provision than what is statutorily required. And our provision coverage ratio also is pretty high. So are we likely to continue on this path? Are we kind of trying to build a buffer for the rainy day? That is the thought process?
No, we have kept a benchmark that for stage 1 and stage 2 assets, we will be having 1% provision coverage ratio minimum as compared to 0.4%, which is the statutory limit. And for the secured one, we are doing between 0.4 to 0.5%. So when we take cumulatively, last year our AUM growth was higher. So our provision for standard asset was much higher. So around 60% has gone for the standard asset provisioning. So that is why the provisioning coverage ratio has increased, and I think these are, yes, we are a little more conservative, and so we intend to carry this policy because we have made a policy. Now we don't intend to change it, and we like to maintain the same policy going forward.
Got it. Thank you. Very useful. Thanks for it.
Thank you. The next question is from the line of Nikhil from SIMPL. Please go ahead.
Yeah, hi, good evening, and congrats on a good set of numbers and what we had said prior to the year, we've actually achieved it, so great congratulations to the team. My question is basically on slide 33, where we have given a breakup of SME retail. On the active accounts, if I have to ask, at the beginning of the year, we had around 1450 accounts, which are around 2076 today. So, of these accounts which we started with, how many would we have been able to retain, and how many would be completely new to the system? And where I'm coming from,
we don't have upfront, but the number of accounts that we boarded was much higher. We have seen a lot of foreclosure in last financial year, but those numbers, what was the foreclosure, and so I think we will start putting even that in future, but upfront, as of now, we need some time to give the data, but right now we will not be able to give the exact numbers in terms of number of accounts.
Okay. So where I'm coming from is
1140 accounts we boarded in last financial year. So the rest opening plus 1140 minus have been closed, either being foreclosed by the borrower or may have been taken over by the other bank.
okay. So where I'm coming from is, sir, if I look at the average ticket size, which was 7 lakh, has moved to 10 lakh, and if I also look at the average LTV, which was around 27%, there we see a jump of 34%. So the newer accounts which have come up, it seems that the average ticket size is also larger and also the LTV ratios are much larger. So I'm just trying.
I will explain that, and Amit will also add. There have been a little strategy on that side because in COVID period, we have seen that prior to COVID, we were focusing more on the 5 to 10 lakh kind of ticket size. What happened? Those are purely rural, one would say, and secondly, those accounts, they were marginal borrowers. Whenever anything goes wrong in their family in terms of medical, health, education, or any dynamics in terms of businesses, so we found that they were coming a little bit under stress, and the quality of the properties. When we started moving into tier 2 tier cities, mostly within the municipal limits or on the borders of municipal limits, where the quality of the property is far better, the vintage of the businesses and multiple business source we start getting. So the LTVs will definitely going to, as we told, we're low habitation area, rural areas, we limit ourselves between 30 to 35. But as you move to more semi-urban or little urban areas, their LTVs we have to go at least 45 to 50% sometimes. So that is the two reasons. And thirdly, we have also found that SARFAESI helps us a lot. And there was a certain strategic decision also that a certain portion of our segment, we will start focusing those small borrowers, maybe 20 lakh to 30 lakh kind of a ticket, and making that 25-30% of our portfolio. So it is not because of SARFAESI, but in terms of we are able to diversify ourselves. The quality of collateral is far better, the vintage of the business and multiple sources of businesses are much more there, and we have found also those people have in terms when we have started taking their net worth and multiple properties also, and that helps when sometimes in stress they are able to dispose of a surplus property, which when you are targeting a very marginal borrower of 5-7 lakhs, has the presence of those multiple.
Okay. And to add to this,
Amit.
And to add to this, like on the strategy front also, we never wanted to go into the rural areas because of the quality of the property. These clients were basically very marginal, and we wanted to operate on a much more liquid market, wherein if something happens within the dynamism of the market, these people are able to have such kind of cash flows that at least 3 to 4 EMIs are at their disposal. So we wanted those type of client on our portfolio so that it becomes little bit moderate in terms of cash flows. Also in the quality of the property, which has to be in the market or a urban area for the sellability and easy accessibility of those property. So it's a much better way to operate in SME segment by this way, by protecting your interest as well as looking after client interest as well. And these kind of clients are basically small or medium type of businessman who keeps on having multiple of business, multiple of properties. So it is easier to operate and communicate with them. They are little educated also from a credit point of view.
Because last year in COVID time, when we were doing this less than 10 lakh, 5 lakh cases, so we came across that sometimes if the dynamics in COVID, the dynamics changed very fast. Certain businesses were closed. They were not able to come back. So being on the marginal side, sometimes to come back or recover from a little difficult stress period becomes difficult for those customers. So, yeah.
Second question is,
targeting 5-7 lakh, doing imperfect collateral, taking last sale deed, doing things are far better, faster.
Also.
Yeah. Strategically we thought, and because lot of introspection went in the COVID period when we analyzed each and every account. So it was that was the one reason because of which I would say LTVs have gone up. So far better collateral we are getting, and in terms of the ticket size.
Yeah. Second question is, now if we consider, and one of the key parameters you said is the ability to match that customer's cash flows with his ability to repay. And if I attach it to the unsecured loan part, which you mentioned in the presentation, what gives you the edge that if we go into the unsecured loan products for MSME in tier 2, tier 3 cities, how much of our current learning can we replicate it? And when we are going into unsecured versus a secured, say if in secured his cash flow was 100 and we were giving him a loan of 20, in unsecured, what would that matrix be which we would like to maintain?
So first of all, we are targeting a particular segment. It is mostly they are catering order based. So when we are funding them, they are taking raw material based on some order. We will be only funding, we will be discounting their receivable of bills, the purchases.
Okay.
So we are not giving just personal loans or business loans. We will be just discounting their purchases which they will be making from the particular set of retailers. So it is I would say, the discounting of their purchases. And secondly, those are mostly order-based raw material which they purchase, and the average period for that segment was 60 days to 90 months. 90 days. So secondly, and whatever we have learned for the secure part, definitely we are putting into that. We built a separate platform. Amit.
Yeah. On this one, see how we are going to coexist together is we are not going out of any of the geographies. We are present there. Our team is present there. We are not making any special team out of it. We are having a data which is the data where we want to go. It is a vetted data in terms of these clients are already there, and the bills are getting funded from us for 50,000 to 2.5 lakhs. It is a completely digital platform. That's the reason we are taking a little bit of time. We are just adding more credit analysis into that, and the underwriting part is also there. Earlier we wanted to fund them, and we wanted to take at least 2 to 3 days, but now we have an idea, and we are targeting that we should give them a loan within 24 hours with the details which we have. The team is there, the credit underwriting, it is a centralized credit underwriting team which will be based out of HO. The sourcing will happen from the same branches where we are operating from the SME. Yes, the ticket size will be a lower side, and it will be a mix of, to start with 10% of the portfolio in the coming financial year, 10 to 15% of unsecured, and remaining will be 85 to 90% will be a secured one.
Okay, and last question. The yield on these loans would be accretive to the average yield for the company. And secondly, on the credit cost side, if we have to consider the credit cost, and because we have both wholesale and SME book, would the credit cost or the provision which we are carrying for the SME book be higher than the wholesale book?
Yeah, definitely.
Okay.
So most of because there is not a single account into DPD on the wholesale, so you can say yes, definitely. But if you see in last 18 months, our gross NPAs, in spite of our book increasing by 200 crores in last 18 months, have come down from 10 crores to 4 crores. Even if on the amount which we have written off, we have recovered roughly 5.5 crores in last 18 months, post January 22, I would say. So on the granular level on the SME side also, it was during COVID when gross NPAs has crossed 2.92 crores and morely coming out of the SME. So from that situation, where at that time 290 accounts in schools were, out of that 65 to 70% had become NPAs, which most of them we have made them regular or we have resolved, barring 15-20 accounts which were less than 5 lakhs, mostly on the unsecured, which we started in that period, which we have totally closed in last 3 years. So in terms of the credit cost, which has come, and it was more of with the COVID period, and in the last 18 months, we have reduced to a very large extent.
Okay, and the yields would be accretive for the unsecured to the total company average yields as of today?
SME and unsecured. Unsecured, no? Yeah, unsecured will definitely target a little higher yield, 20 plus times. And what we are saying again and again, we don't know the dynamic. We have to see the dynamic. And somewhat, if we find that that segment is extremely fine and where our operating cost and repetitive customers and the credit cost is seen as a much lower percentage, we may reduce it. So the dynamics of the business will ultimately determine the IRR. But we will try the 20% plus to start with.
Sure, sir. Thanks a lot. I'll come back in the queue.
Thank you. The next question is from the line of Rupesh Tatia from IntelSense Capital. Please go ahead.
Thank you. Thank you for the opportunity, sir. I have 3 or 4 questions. So, first question is on the SME side. Can you give me 1 to 30, 30 to 60, 60 to 90, and 90 plus DPD?
Yeah. DPDs. Yeah, now it is already in their balance sheet. I think it will be get uploaded in a day or 2. So where notes to accounts have a complete details of that 0, 30, 30, 60, 60, 90. But I would like to add a little point on that. In our segment, sometimes bouncing percentage is between 12 to 14%, where out of that 80, 84, 85% gets collected directly when we go through a NASH at the time of presentation in the first week of the month, and 98 to 99% gets collected. And certain people, if they fail in a particular month, they pay 2 EMIs, next month they become regular. So certain new customers come because sometimes certain businesses are seasonal. When you are targeting a tier 2, tier 3 city and small businesses, all businesses are not at the same velocity every month, and because of some seasonality, some encountering any health issue, some having any marriage and all those, certain sometimes one can see a customer missing 1 or at the max 2 EMIs which getting regularized, and sometimes a new customer comes, and because of that there are a few customers you will find in 030 to 3060. But if you see that track record, they are coming back, some new may be adding. So it is because of a certain peculiarity of this segment where we are.
Yeah, I understood, sir. The reason I'm asking this question is in SME, our collection efficiency is 98% for most of the quarters. In Q3, I think it was 99%. And
I explained
the gross NPA number hasn't moved. So
when we say this collection efficiency 0 to 90, so if a customer slips in a particular month, the other customer is being substituted by that which has slipped. So the efficiency for that that remains between that 98 to 99%.
Okay. Yeah, sir.
If you still not able to understand, Amit, you can explain.
Yeah, so the percentage which we have seen, 98%, what rightly said by Rohit sir, that in this kind of segment, sometimes a customer slips from 030 to 3060 DPD because of unprecedented reason, maybe medical, maybe, some kind of unforeseen, expenses are there. So he slips from one bucket to different bucket, but in the next month he gives all the EMIs when the situation is, better. So that is the reason sometimes it overlaps the, the payment done by one client, and if he misses, then he pays in the next month. Some few of the client misses in that particular month, and then he pays. So it's a cycle which keeps on going from month on month. But we have a target of doing collection efficiency of 100%, but we end up doing 98 to 99%. So that's the reason it has been given 98%. Nevertheless, the collection piece which you are seeing, if you see on an average, it is almost in 0 to 90. We cover all the cases by the month end.
Yeah, understood. Few branches do 100%, some branches do 94, 95. So the average comes out to 98.
98.
Understood, sir. Understood. My next question, sir, is can you give me what is the mid-sized lab book or SME lab book as of March 23?
Lab book.
Not able to understand, sir.
So you are asking SME lab book or the overall book?
Yes. I am asking SME lab book.
So on a cost side, if you ask...
I have understood. So he's talking about our high ticket retail one, SME lab book around 85 crores. These are small, I would say small to mid-size borrowers and more into the NCR, far better collateral, and where LTVs are lesser than 40-45%, and mostly they are in the NCR region as of now. They are far better, and the predictability of cash flows are far better.
Okay, and
low just compared to that. They are being averagely done at 16 and a half, and as compared to that.
Okay, and what is kind of like growth outlook, sir, on this book for, let's say, FY24? Would it be higher than company AUM growth average? Would it be lower?
I would say the maximum, in terms of percentage going forward, year on year, you will see the growth on the SME side, followed by a little bit depends on the dynamics between the two, SME lab and the wholesale. But yes, definitely going forward, year on year growth will be higher on the SME side.
Okay, understood, sir. So next question, sir, is you said credit rating review will happen on FY24. So can you maybe list 2 or 3 major requirements, for credit rating upgrade that you have?
Yeah, requirement. Because sometimes few says ki 1,000 crore is a benchmark. We have already said this, but I don't know whether it's an unofficial guideline or not. And the other, mostly what we encounter is the top 20 customer and geographical presentation of our wholesale. So that is 2 basic things. In spite of that, we're telling them that we have been doing for last 11 years. So our track record and all those, but whatever, that is the bare minimum, I think exposure we could have by taking the complete control over the project and the cash flows. And these are competitors, they do a much higher ticket size. So, but still that has been 2 major concern, and we say that we are a small company going into newer areas without much more, I would say, funds. Doesn't make sense to do small businesses in newer pockets, especially on the wholesale. I'm talking about this only about the wholesale. So as and when we are growing, we will expand to other areas. We targeted Chandigarh suburb, which is a kind of mini NCR, across Panchkula, Mohali, Derabasi, Zirakpur. But we found that still market is not mature the way we want to look at things. Though there is a lot of boom in the real estate in that area, the kind of developers or small-time builders which are there, they were not to our parameters which we have laid ourselves, doing certain things which are not properly getting vetted from the authorities and all those. So we don't want to go beyond our parameters, and in spite of keeping a reasonable team there, meeting a lot of potential borrowers, we found that still market maturity is not there at this time, and we will wait out for another 6 months to 1 year to see it again. And now we want to look at some part of Uttaranchal because it's coming up in a big way, especially Dehradun, Rishikesh and Haridwar side, and little bit maybe on the Lucknow. But these are only on the radars, and we do extensive 6 to 9 months research by keeping a full-fledged team and meeting potential borrowers, and then taking a plunge.
Okay, sir. Understood, sir. Next question, sir, is when we have 19% yield on the SME book. I saw in your presentation that 99% of the collection happens digitally. Based on experience in some of the other segments, at this kind of yield, 19% yield and that small ticket size, this kind of business is a human touch heavy business, is what my understanding is. So, how often your loan officer or whoever collection person meet the actual customer? How do you balance that?
See, basically, you are right. You are right, absolutely right, that the human touch is required in SME. And to update you, it's 100 and 110% human touch which we are doing. You will not believe that when the customer is onboarded, I'll start from onboarding. So, right from the RM to branch manager to credit manager, up to regional credit manager, then zonal credit manager, and if anybody from any of us in the leadership team is also traveling, also meets the client irrespective of the loan amount. So the human touch is there right on the onboarding. Pertaining to that, post disbursal also we have an exclusive audit team which visit the client before check handover also in most of the cases, just to check whether the customer has been informed about the company's policies, parameters or not, and whether the the businesses which has been seen by credit team is it at par with the audit team also or not. This is onboarding and post disbursal process. Coming on to the collection, we are 99% digitally. We are collecting all the payments either through NACH or through our M Collect app, and that's the reason we have written 99% digital, because instantly we give a receipt to a customer once he pays the cash, and the cash is deposited immediately into the branch.
I will explain here little bit what was briefly. When we put a NACH, 85% collection comes through the NACH digital mode. And now I will give a more granular data. In Rajasthan, we are for the collection side, we are collecting 80% through digital, 20% through cash mode. And in Punjab, Haryana, and Rajasthan, and Gujarat, and Uttaranchal, it is 50-50. So if we take that, more than I would say 90 to 93% is through digital mode. 7%, what Amit is saying, we are doing 100%. Our collection team is on a digital platform. They are not giving any physical receipt. The moment he gives the cash, in certain cases the receipt, email, WhatsApp simultaneously get triggered. So that is the journey. Otherwise, yeah,
that's through app only.
That's through app only, and 93 to 94% is coming from the digital way, maybe through NACH, UPI, and other way of payments, and 7% is overall cash collection, which is happening digitally.
Okay, sir. Okay. Another related question, sir, to this is in your SME side, how do you see risk of balance transfer? And the reason I'm saying this is that your cost of funds is high. It will remain high compared to let's say banks and small finance bank and all of other guys. The cost of funds will continue to remain high. And you are kind of creating a digital trail for your customer. And I heard you say that a lot of your customers are new to credit customers, but after 1 year or 2 years they will have a pretty decent record, digital record. And then what is the risk of balance transfer?
So the risk of balance transfer, like you said, that these particular clients are new to bank or new to us. So average, what we have seen, what I have seen in the past 18 months, that we only have around 10 loan which has been balance transferred from us to different financial institutions. And the major reason was their requirement of the top-up amount, which is beyond our ticket size. Generally, these kind of customers try to remain with us of the idea, because we give fixed rate of interest to them till the entire tenor. And average, they remain with us for around, like I said earlier, 24 to 36 months. So I don't see in coming year that there will be much of a balance transfer happening from us.
But that balance transfer is happening in every industry, everywhere. larger even one going for corporates going for lesser to new bank for 0.5%. So those things will always be there. The focus is that we work within our domain knowledge, our target audience, and keep on doing business. And still, I would say again and again, this is the only segment which is under-penetrated. The other ones, more of the metros and all those, have been penetrated where I would say sometimes service or your pricing plays a larger role or the amount which you can give. And more of that of late, especially the PSU banks have realized that it is better to work with the NBFCs on co-lending format, the segment which we are.
Okay, sir, understood. And my final...
sorry to interrupt. We request that you return to the question queue for follow-up questions.
Sorry.
We have other participants in the queue at the moment, sir.
Okay.
Thank you. The next question is from the line of Vishal Prasad from VP Capital. Please go ahead.
Thank you. Rohit sir, I have one request, if you could. We do our AGM at the end of the cycle, probably between 26th to 30th of September. And past few years, we are very open with our communication. So is it possible for you to take a look and schedule the AGM a bit earlier? Because last week there's a lot of rush and we keep on missing a lot of AGMs.
We will take your valuable insight and try to do that. What happens now, we always target these annual reports and fine-tuning it and sometimes all those. Yes, we will give an earlier deadline and all those, and we will not bunch up during last 10 days, and we will try that from this year onwards. It is being... secondly, the second reason sometimes was when it used to happen physically, lot of those people which have no interest, especially in North India, they come in such a huge number. 300 to 500 people will come and create such a huge nuisance. You have to call police, and their only is to demand small money and all those things. So, हमें लगा कि AGM का जो main purpose है to speak to and who wants genuine any answers or want to listen it, get defeated. Even those small number of people who come for that purpose, they are also not able to participate.
Okay, I was about to...
बहुत अच्छा लगने लग गया था कि virtual होने लगी थी तो things were far better. The genuine people were coming and I don't know, Mumbai में ऐसा trend नहीं है. In North में there is a special teams which are doing this way.
I was about to ask आपसे कि आप physical AGM करो, but hearing to what you have said, it is okay. Yeah, so two more questions. Yeah, one second. Usually, if a branch does good, how much time it takes to break even and to reach 10 crore of AUM?
So, Vishal, it depends on the market also, and we have categorized our branches into A, B, and C also. That so suppose a branch in Jaipur will definitely reach to a 10 crore AUM faster than the branch which is based out of a smaller place, maybe like Rajsamand or Sikar. But ideally, if you average out 10 crore, reaching a 10 crore will be after a year, at least 13-14 months is required. Because first 3 months branch takes, if a branch is new, it takes their own sweet time to come up to the market challenges and everything. But we have kept an average target of around 80 to 90 lakhs per branch. So looking into that, by the end of this one financial year, we target to do at least 10 crores per branch. In this financial year also, at least it takes 12 to 13 months to reach 10 crores with this pace particularly.
Okay. And in our wholesale lending, we have mentioned that we usually, not usually, but sometimes we partner with some of the co-lenders, but we haven't mentioned the names earlier. So is it possible for you to name our co-lenders?
Primarily, we were working with one co-lender, NBFC, and so now from this year onwards, we have started doing downselling. We have done one transaction with Kotak, one with TXCI. Now the focus this year will not be reducing our business, but be doing the same or much higher amount of business, but then bringing them through co-lending mode and assigning, downselling them, assigning them. So this has been, that will add to our gross IRR, and still our presence in the market will be there, that nobody will be able to say that we are not doing lesser business. At the same time, on our book, the percentage rise will not be that much. So that has been the core target for next year, to do higher business but still remain within the limits on our books which we have thought. And to name an NBFC, I have no issues. Rajasthan Global Securities, which is around 1500 to 1800 crore kind of an NBFC, and which have been doing it for last 4 years. We only board where we see that our ticket size is going beyond 15 to 20 crores, but we need the total control, where complete onboarding and assessment and monitoring on daily basis is done by us.
Okay, and sir, last question, since our cost of capital has gone.
Due to paucity of time, that would be our last question for today, sir.
Yeah, sure.
Thank you. I would now like to hand the conference over to Mr. Rohit Gupta for his closing comments. Over to you, sir.
Well, thank you very much. I think we had a reasonable discussions. Otherwise, the people who were not able to participate, but from the questions that we have already taken, you must have got a reasonable overview, and most of them questions must have been resolved. And still, you can speak to our IR team or to our secretarial team if somebody has any specific questions. And so again, thank you everyone for participating in the call. Your questions are important to us, and we strive to be transparent in our investor communication. So thank you very much again.
Thank you. On behalf of TIL Advisors Private Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.